Investing can be really intimidating if you're young, and especially if it's your very first time. And that's why in this video, I'm going to tell you exactly how you need to invest your first $1,000. If you're new to this channel, I want you to hit that like button, subscribe, and turn on notifications so that you don't miss out on how to invest with the help of a professional. Look, investing is extremely important. And when I mean important, I mean if you're not investing, you are not helping yourself at all. You see, when we talk about the value of your money, it's always losing value. And the only way you can combat this is to make more money or make more money. And one of the best ways to do that is to invest, because now your money is working for you. Think about when, if you were younger like me, you would go to the ice cream truck and maybe you spent $1, and let's say it was 1993. That $1 that you spent on that ice cream, if that dollar were to travel through time to 2023 or 2024, 2025, that $1 would need to be $2 to buy the same exact ice cream. And this is without even talking about any of the additives or how they've changed sugars or anything like that. Either way, the value of your dollar has changed. In fact, it's losing value the more we move forward in time. And the only way to combat that is to make sure that we are proactively doing something to fight that. One of the first steps to do this is to start with work. Yes. Think about where you currently work and take a look at your employer-sponsored retirement plan. It's really important because your employer has budgeted money already to just give to you towards your retirement. And if you aren't optimizing that, then there's a chance that you're missing out on certain opportunities, because that money that isn't utilized just goes back to your employer. So I really want to make sure that you're taking advantage of that. But then also, I need to know that you are currently working, because if you're not going to be able to build the temperament necessary to invest. So when we talk about your workplace retirement plan, I'm talking about a 401k or a 403b or a 457b plan. These are plans where you'd be able to select from funds and invest automatically through your paycheck, basically. So if you aren't taking advantage of that, I want you to just hold off on investing for now. It's extremely important, because I need you to figure that out, and we need to make sure you have a steady stream of income so that you are ready for the ups and downs that come with investing. If you aren't quite sure about a traditional IRA, Roth IRA, or your 401k plan, I want you to watch this video right here where I break all of that down and leave no room for confusion. And if you think that your situation is unique and maybe you should be investing even though your income is not steady, feel free to shoot me an email at info@financiallypresent.com. I don't mind taking a quick look to just see and tell you, hey, keep on the same track or hold off and wait to start investing. I don't mind doing that at all. And obviously that leads you to the next step, which is open an account. And when we think about investment accounts, they're generally called brokerage accounts. And I want you to picture a house. And there are obviously different types of houses, but when we talk about brokerage account houses, there are some houses that are tax advantage, and then there's others that are taxable. What happens there is anything that's tax advantage has a different type of set of rules attached to it. And then when it's something that's a taxable account, there are less rules, and you just know that anything that's made in there is going to be taxed. It was pretty straightforward, but either one of these types of houses are going to be completely empty when we consider accounts. And as you know, with a house, you have to, of course, if you want to enjoy it, put in furniture, appliances, and other things to help entertain you, and then you move in, and those items are considered the investments themselves. You can have a lot of the same things in either one of those types of houses, but at the end of the day, there are different rules depending on the type of house. So again, tax advantage is going to have a different level of rules. So we're talking about traditional IRAs, Roth IRAs, and so on and so forth. And then when we talk about taxable accounts, those are individual accounts, joint accounts, custodial accounts, trust accounts. They're all taxable. If you're trying to figure out what type of account to open up, depending on the type of investing that you want to do and you need a recommendation, I want you to check out this video on how to open up a Charles Schwab account. I have about 11 accounts there, and no, I'm not affiliated in any type of way. This is not sponsored, but at the end of the day, they have a lot of good resources, and I want you to check it out so that you know exactly how to open up an account and pick the right account type for your situation. Just know that you can't really do anything if you don't have an account. There's no buying or investing without an account. And of course, the next step is to fund the account. You need to be able to transfer funds directly into your brokerage account so that you can start investing. So if you've ever used anything like a Cash App or Venmo, or used a banking app where you transfer funds between your checking and your savings, it is very, very simple and similar when it comes to a brokerage account. So whether it's you're scheduling funds to regularly deposit into your Roth IRA, maybe $25 a week, or you're deciding that you want to put $100 a month into your individual brokerage account, you can easily do that. And on whatever schedule or cadence you want, I recommend doing something that's automated so that you get those habits formed naturally. If you leave it to just your own devices of trying to remember when to make those deposits, you most likely won't make consistent deposits into your accounts, and you most likely won't consistently invest, and you won't really take the full benefit of what the investment market will offer. But if you've transferred funds in any of those capacities, whether it's a bank account or online banking app or any of these peer-to-peer paying methods, it's pretty easy. So you have to do that next. Now, all of that takes you to the best and most fruitful step, and that is invest. You've done all of this, you've looked at your employer plan, you've opened up an account, you've transferred funds, now you have to put those funds to work. If you open an account and don't do anything, you haven't started the battle. You have to invest. And if we had to split the market into two specific categories, we have stocks and we have bonds. There are different ways to invest in these two things, but when it comes to stocks, just know that you have to do some research, you have to have a tough stomach, and it all depends on your risk. So any type of stock advice, you need to make sure you're vetting that and doing your own research. And then even after that, there's going to be a lot of ups and downs to make sure that you are comfortable, or you have to make sure that you're comfortable with those ups and downs and the decisions that you made in your investment account. But you need some stocks to really have fun in the stock market. So you can do that by investing in mutual funds, which are a basket of investments, or exchange traded funds. And those are baskets of investments that essentially trade like a stock. So they're, I would say, more portable, basically. And there are some other nuances when it comes to stocks, but those are the main ways. You can always buy individual stocks as well. And then bonds, on the other hand, those are essentially agreements that you have. You've loaned money out to someone and they're going to pay you interest back. And at the end of a certain period of time, they're going to give you the money that you loaned them back. So when it comes to those bonds, you just know that the risk is much lower for bonds than it is for stocks. Stocks, high risk, but then also high reward potential. Bonds, low risk and lower reward potential. As far as investing in stocks, I think one of the best ways, in my opinion, is an ETF, an exchange traded fund. Usually the fees are much lower, and this is why I like them. And then it's very, very versatile as far as just the strategies you can use them for. It can be short-term or long-term, so it's very, very helpful in that way. But if you know exactly what you want to do, mutual funds can equally cover those same bases. But the whole premise of these is that they are diverse, okay? And when we talk about diversification in investing, it is extremely important because it protects you as an investor, but it also allows you to be right about multiple things at the same time. You know that trick when a magician lays on a bed of nails and somehow they're perfectly fine? Well, it's not really a trick. It's more of the fact that they have not just one nail balancing their full body weight, but they have hundreds, maybe thousands of nails all evenly distributed so that they can comfortably lay on top. It creates this flat surface and it disperses the pressure of the weight against the nails. You rarely see a magician do the trick where they're standing on one nail or two or three or four or five, but I want you to think of each nail as an individual stock. And that's why mutual funds and exchange traded funds are so popular. You can invest in something that has ownership in so many other companies, and you're not relying on one or two different things. You're not relying on a couple news stories collapsing your whole portfolio. So it's really important that you have diversification in your portfolio, and that's what mutual funds and ETFs can offer. Mutual funds and ETFs are professionally managed, so you need to understand that someone has to get paid for professionally managing that fund for you. And that means there's going to be an expense ratio. It's going to be a percentage of the assets managed, basically. So know that if you're investing a certain amount of money into a mutual fund, there's a small percentage that has to go to the management of that fund. And in general, you're going to see that fees that are less than 0.5% are generally okay. When they're more than that, you most likely are overpaying, in my opinion. Again, in my humble opinion. But there are a lot of funds out there that you can find and still have the diversification that you need and pay less than 0.5%. So just be mindful that if you're going to buy these mutual funds or ETFs, take a close look at the expense ratio, because the cost over time really can affect the growth of your assets. Look at something as small as 0.25%. Look at something as small as 0.4% and what that looks like over time, or what does 1% look like over time, over the growth of your portfolio for a number of years. It may seem like a small amount now, but over time, it's gonna look like a lot of money was left on the table, or not really left on the table, but given to an investment manager. And when some funds that are actively managed, meaning that they're choosing the funds for you left and right and buying and selling in the portfolio, when some of those funds aren't doing so well and you realize that you actually could do better with a more passively managed fund that follows an index, you'll realize that sometimes the lower fees they're okay. When we talk about lower priced funds, we're really talking about index funds. And an index is just a snapshot of the stock market. There are multiple snapshots that are very well known. One of them being the Dow Jones Industrial Average, the NASDAQ 100, but the S&P 500 is generally the most popular one. And it's a snapshot of 500 of the largest companies and their performance, all wrapped into a fund that doesn't have to do anything different other than just follow the performance of those 500 funds. In fact, the S&P 500 has done immensely well compared to actively managed funds. So the grandfather of portfolio investing, Jack Bogle, actually just said, if you follow this index and invest in it regularly and often, you will do more than well enough as far as investing is concerned. And some people have been able to get by perfectly fine without cherry picking stocks. They just buy an index fund. So index funds are low in cost and you get the diversification. You're covered across companies, hundreds of companies that are well known, and it grows, right? Over 10% on average each year. The beauty of these type of investments is someone has done all the legwork for me, and think about if you wanted to, I don't know, make some tacos, and maybe you might get all of the seasonings, the salt, the pepper, the garlic, and the chili powder, and all these different things, and you have to measure it and do it a certain way, and put it all in with the ground beef or whatever your pick is for that Tuesday. But at the end of the day, you could do that, or you could go to the store and buy the seasoning packet already mixed for you. They even have organic versions or versions without sugar and all of the other stuff, so you can literally pick the flavor you want, and it's still diverse enough with all of the right measurements so that you don't have to do the work. So one of the tricks that Jack Bogle always recommended was to make sure you own your age in bonds. And what he meant by that was that if you're 30 years old, then you should own 30% of bonds, and the remainder of that, which would be 70%, should be in stocks. So if you suppose you're 20 years old, you need to own 20% of bonds in your portfolio and 80% in stocks. And this is a great rule of thumb to just quickly remember how much risk you could bear in your account, but it's not something that you have to abide by. It's just a guideline in a sense, or a suggestion. If you're like me and you like a little bit more risk, then feel free to sprinkle some individual stock and some other investments, but you have to be comfortable with those decisions. As far as actually investing, suppose I'm 20 years old, I know, yes, 20, me. But that means I need to own 20% in some type of bond fund and then 80% in a stock fund. Just for simplicity's sake, let's go with the Charles Schwab S&P 500 mutual fund, which is SWPPX. Very low expense ratio and very easy to buy. I would essentially take $800 out of my $1,000 and buy this particular mutual fund. The order is going to complete at the end of the business day, because when it comes to mutual funds, they calculate the value once a day, and that's after the market closes. And that's pretty much it. I would actually also select for the funds to be reinvested, so that as I'm getting dividends and there's cash distributions of those funds, they can be reinvested into the purchase of more shares of this particular fund. And it's gonna grow exponentially for me. And this is without me even having to add money to this particular investment, which I recommend down the line. And then as for the bond allocation, remember I'm 20 years old now. I would recommend doing something as simple as buying some shares of SWAGX. It's an aggregate bond fund created by Charles Schwab. And basically the $200 that I'm going to be using, I can select buy, hit select reinvestment for the dividends and distributions, and that's pretty much it. Now I have a portfolio that has a stock and bond allocation that I'm comfortable with, and if I needed to make changes down the line, I can. And then if I also wanted to add additional funds to that, I can. All I have to do is just purchase more shares of each fund. One thing you need to remember about mutual funds is that depending where you are, the fees may vary. So for example, if I'm at Schwab, then there's a likelihood that I'm going to get a better advantage on the price or the discounts when it comes to buying funds at Charles Schwab, or buying Schwab funds at Charles Schwab. But it doesn't mean I can't buy other funds. It just means that I may pay a little bit more, or there's some additional fees. So a Fidelity fund that's exactly the same, let's say instead of it being SWPPX, let's say I buy the Fidelity version of that Charles Schwab mutual fund, and it's FXAIX. That's perfectly fine. It actually has a lower expense ratio, but it does have a fee of about $75 when you purchase it. That's if you're buying it at Charles Schwab. That fee is non-existent if you buy it at Fidelity. So just be mindful of that. If you're buying a fund and it's not native to the brokerage firm, the fees may vary. Some last tips. Make sure that when you buy any type of mutual fund, especially if you want long-term growth, select dividend reinvesting. This is a great way for it to automatically buy for you. You don't have to even watch it on a regular basis. It's constantly working for you. So as soon as the stock pays a dividend and that mutual fund receives that dividend, it will be dispersed to your account and then repurchase additional shares. So you're going to see fractional purchases. They're real small, but trust me, over time, it really makes a difference. That long-term reinvesting is going to help with the compounding value of that account. Next thing you can do is just be sure to add your own flavor. Again, this is a very plain vanilla type of account, but it doesn't mean that you have to be confined to this. You can buy individual stock. If you feel that you've done enough research and you're open to the risk and you know enough about the company and you're okay with holding it long term, feel free to buy an individual stock. It's not for everybody. Some people are index fund, mutual fund people only, and that's completely fine. No offense to them. But some people need things to be a little bit spicy. Just know that wherever you invest, whether it's individual stock or mutual funds, it grows the most wherever you water. So think of it like a plant, whatever you take care of the most. If you're gonna invest regularly into individual stocks and you're continuing to buy shares, then those will probably do well because you're doing a lot of research and maybe you're that type of investor. But you can do equally as well, sometimes even better, because you're reducing your risk by buying index funds and mutual funds through ETFs or mutual funds. And one of my last tips is to keep a long-term focus. Just invest as long as you can and as often as you can, because it's not the people that are investing and buying in and out of stocks and doing day trading or swing trading that are building the real wealth. Yes, they'll make money, but the real wealth is through long-term investing. And if you have any doubts or aren't sure, check out this video where I talk about the best strategy, the best investment strategy known by Warren Buffett, Ray Dalio, and even Jack Bogle as well. Stay present.